Well, let's get started. Welcome, everybody. This is the webinar for Capital Flats. We're going to be presenting a 79-unit redevelopment project in Harrisburg, Pennsylvania. New construction, office to multifamily conversion. Quick disclaimer, little housekeeping. This confidential offering memorandum that we'll be covering today is intended solely for accredited investors and cannot be shared without Banksmore's written permission. This investment involves risk, and potential returns or projections are based on assumptions that may not reflect the actual outcomes. Various unforeseen events beyond the control of the company and the sponsor can significantly impact the results. Investors should understand that actual performance may vary from the estimates that we'll provide. Please review the detailed information in our private placement memorandum and consult with your own advisors prior to making any commitment. This is a 506C offering for accredited investors only. Let me give you an overview of what to expect here today. It should take roughly 25 to 30 minutes, we hope. And we're going to touch a little bit on what we consider to be the four key functions of this project and investment opportunity. The total offering and participation available is $2.6 million. The minimum to participate in this project is $150,000. We'll start first with the team introduction, talk a little bit about the people that are involved in this project, our experience, and our unique skill sets that we believe makes us extremely qualified to get this deal across the finish line. We're then going to talk about why we've selected this project and some pretty cool features of the projects, from floor plans to amenities, location, a little bit of the economic background about how we chose an office conversion to multifamily and what's unique and we think extremely advantageous about the location that we're developing this project in. I'm then going to talk about the investor profile. What do the returns look like? Answer a lot of frequently asked questions that we get in regards to rate of return, and then how the financial upside is shared with our investors. And then ultimately, we'll talk about what we've done to mitigate risk, and then also what we believe are the important parts and partnerships that we've made to drive the project all the way through to the finish line to ensure success. So I'm going to tell you a little story here today about the background of this group and how we got together. Each of the four people that you'll see here on the Banksmore bio page was working independently of each other up until about 9 to 10 months ago. Each of us active in multifamily, active in construction, active in other partnerships, but seeking to do something of larger scale with more significance that could have a massive impact in our communities. And the four of us came together and develop this partnership. And I think what's really unique about this partnership as you scan over the range of experience that each of us has is that running a business and certainly doing a project of this significance requires a diverse set of skills that is very rarely, if never, possessed by one or even two people. So what we've assembled is, we believe, a team that's able to contribute at an extremely high level based on their experience, their unique skill set, and what they bring ultimately from a culture perspective to the team. Myself being exclusively focused in this group on team building, culture, and using leadership to attract high talent and a high character vendors, partners, employees, contractors, bankers, all across the board. It takes a significant contribution from a number of parties to do a deal like this. So we want to make sure that we're attracting high quality talent. Ken, as our Chief Investment Officer, brings a very disciplined approach to financial modeling and is one of the more difficult people to get a deal through underwriting in. So he brings a level of discipline and financial modeling that's extremely valuable in these types of partnerships. Clint has an extensive background in construction and development, and he's always hunting for great deals for us. So he's extremely involved in acquisitions and locating value add opportunities for us, much like this one. And he'll touch a little bit on the background of this deal. This deal and this property were years in the making. and excited to have him walk you through a little bit of the background of the project and how we got here. And then Josh, with a strong background in mergers and acquisitions. I've known Josh to become an extremely disciplined operator. And when I think of Josh, I think the art of the deal. And he brings a tremendous amount of value in structuring of partnerships, structurings of deals, and is extremely instrumental in our conversations with institutional debt and banks and making sure that we structure the other portion of the financing in a very lucrative way. So just super excited about the team that we've put here and wanted to share a little background about how the four of us got here today. So what does that all look like? At the end, all of that experience results in 70 plus years of combined real estate experience across commercial and residential real estate investing. Individual portfolios. We've, on our own, invested in over $185 million of real estate, in excess of over $50 million of sold assets. And we have raised and returned over $50 million of investor capital. The other thing is we can't do this alone. We lead and manage over 100 plus employees. And I think the thing that really brings us together, that gets us excited about doing these projects, is it's community driven. This will impact not just the 6 people on this team or the 30 plus people on this webinar. These projects are intended to have a legacy of impact in the communities that we invest in that will last long after any of us are still here. These projects will leave a legacy long after we're gone.
So let me jump in here. Thanks, Eric, for that great kickoff to the webinar. So I wanted to touch on why there's an opportunity in this market and across the country. So this data that we're going to share with you is from Zillow. I recently just came out this summer, and Zillow had published a research that showed that in the United States, their estimate was that there's a housing shortage of 4.5 million homes that has built up over the last slightly more than a decade. So we have such a significant housing shortage in this country in many, many different areas that even with a very high rate of building will not be met for at least 10 years. And the reason that this shortage exists is because for over 10 years, probably more like 12 years, while the population of the country grows through both organically and immigration, and the economy has grown, there has been the replacement rate that houses need to be built at, the amount of homes that were being built was well below the replacement rate. So we essentially have built up a shadow demand that has not been met. And that's why projects like the one that we're sharing with you today, which is only 79 units, you could consider a drop in the bucket. But these are the kinds of things that we're going to need to do as a country to meet this incredible housing shortage. And zooming in then from the national housing shortage to the area, the Harrisburg market, obviously it's a tier 2 market. It's a smaller city, but it is the capital of Pennsylvania. And so one estimate that we ran across suggests that the need was for 295,000 housing units in this area, but currently there's only 252,000 units. So there is a shortage in this area of 42,500 units. And our project, which we're going to talk about, is only 79 units, but 79 units and some other projects and other homes that is working towards this opportunity that exists. And by the way, the 4.5 million housing, the home estimate, that's one of the lower numbers I've seen. I've seen estimates as high as 11 million homes is a shortage that's existing in the United States. So there's a lot of wood to chop, and there's a lot of opportunity for investors to help meet this need in the marketplace. And as you would expect, because what we're talking about is supply and demand in a sense. We just talked about how the supply is much lower than the demand. And what this data shows here on this page is that, as you would expect, housing prices are rising a lot faster than they would if the supply-demand balance hadn't been there. So on this chart, we're just showing 5 years of data, but as you can see, the median sale price of a new home has gone up quite substantially in this time frame. And pretty much no matter where you look, there's not only a housing shortage, but affordability has been going down. And in this chart, we're also showing that interest rates have gone up. So we're obviously in the context of an election year. And this is a big issue that's on people's minds, is affordability. Housing is one of the biggest inputs into inflation. So the fact is that there's incredible demand for both housing and especially affordable housing. And as we'll touch on later, this project relative to these type of numbers here that we're showing is quite affordable.
Thanks, Ken, for those great insights. My name again is Clint Hurrah, and I handle the acquisitions and oversee our project's construction developments for Banksmore. I'd like to take some time now to walk through some of the history of the building, our building construction, floor plans and layouts, amenities we're looking to offer, some key features of what we're looking to do with the building's exterior, and lastly, some key points about our construction and cost and budgets. So let's discuss for a minute about how Capitol Flats project came about and a quick history of the building. I think it'll help set the stage for some of the things that come in this presentation. This building is 84,874 square feet and is a former office building. Originally was built as a bank's mortgage processing center, where they took in thousands of pieces of mail to process mortgage payments. Over the years, the technology and the evolution of paying mortgages online, the need for 80,000 square feet just wasn't necessary. So the personnel at the bank shrunk, and it kept shrinking. And as M&T Bank acquired the building through an acquisition of another bank, the 84,000 square foot building just became host to more of the bank's technology and their servers. Which were processing more of the online payments, and they just had fewer and fewer employees. Up until our recent purchase, M&T Bank still had a few team members at this location. The property was under contract from November 2023, and we officially acquired it on May 2024. We purchased it for a closing price of $1.5 million. In terms of the location, it's located in a thriving neighborhood with excellent access to major highways. It's making it ideal for a residential conversion. Now, consider the cost we're saving today. Just the shell would have cost us about $5 million based on replacement cost. What this means is if the building were to be destroyed by some event, it would cost at a bare minimum $60 a square foot to reconstruct it. So when you take 84,000 square feet at $60 a square foot replacement cost, that's almost $5 million, a little over $5 million. Now you subtract the purchase price, which includes things like the land, stormwater management, and the parking lot, and you come in with a number about $3.5 million, which is value that we've created in our acquisition. This offer is exceptional value from the acquisition stance, but it also limits the need for ground up development and also eliminates some of the risk associated with those style of builds. We already have foundations, a roof, utilities. So some people say that conversions are a little bit riskier, but I think in this situation, I'd strongly disagree. And, we'll get to that in a few minutes. So next, the floor plans and building construction. Let's talk about the overall layout of the building, its construction, and how the project presents itself for this most optimal layout for this conversion. Let's start with a typical office building. Most are large square buildings with large interior corridors, maybe interior offices. The issue becomes is when you try to do a conversion, like what do you do with all the extra space? You can't put apartments in the middle because there's no windows. This is probably one of the biggest issues when an office is trying to be converted to multifamily. Now, that's not to say that our 84,000 square feet, we don't have some extra spaces to work with, but rather ours is laid out perfectly due to the building's construction and the sizes, which is giving us an optimal footprint to start with. The ability to create great apartments with a diverse layout of 1 bedroom and 2 bedroom units ranging between 700 and 900 square feet is hitting right on the head of what we need to be at for the most popular and rentable units in the area. Now let's talk about how this happened with the property. As the building is more of a longer rectangular shape, it has a smaller width, more windows flanking down both sides of the building, um, which is creating a better layout. This building is also constructed of what they call a slab and column method. And what this basically means is the building is built like a 50-floor skyscraper you'd see like in a downtown area. It's all concrete. They pour a vertical column, and then using rebar and some other methods, they create an elevated slab. And they basically repeat this on the floors above as they go up. They just keep going to make the buildings taller. So here we're only 4 stories, so it isn't as crazy as some of the things you might see in like, a major downtown area, but it's still the same building practices that were used. What this really means is that we have like a rock solid foundation to build off of. We don't have to worry about, if the wooden floor joists are okay, if the roof trusses are okay, is there exterior sheathing? These can all be typically constructed out of wood. And with age, they present major problems that are hard to see. With concrete, it's a different ball game. These are expected to last substantially longer and give us a great starting platform to work with. The column layouts couldn't have been done any more perfectly to accommodate our apartment layouts. I guess the point is that when you start with a solid foundation and you have this free span building, with some of the right key features and design elements that we will take from this ugly existing office building and revamp it into a modern and stylish project that people want to call their home. So we also will be offering some fantastic interior design features for all the apartments that will also attract the tenants. The apartments will include luxury vinyl tile. The units will have no carpet anywhere. This is also a new thing people are wanting and also help us, with our repairs and also our unit turn cost. Other features will include upgraded kitchens with things like soft close, cabinets, quartz countertops, stainless steel appliances. A lot of the bathrooms will offer maybe upgrades with stand-up showers, and all units are going to have washer and dryers in the units. Oh, and I almost forgot the ceiling heights. The ceiling heights are going to range between 9 and 10 foot in all the apartments. So this is going to make the units feel even larger and more like a loft style, which nobody in the area is offering. So as I talked about a second ago, can you go back one, please? We're going to go to amenities real quick. I want to talk about some of the actual amenities beyond the inside of each unit. So with the homes comes amenities, and that's what people want these days. So not only will our floor plans offer the upgrades I just spoke about, but the building will also host an array of desirable features. Just to name a few, we will be offering a 24/7 fitness center, an interior mailroom with package area, on-site leasing office. Another great feature is our inside bike storage area. One last thing to highlight is, during our pre-construction design stages, we were able to find some additional revenue generators by adding rentable storage lockers in the lower level. These will give tenants a great access to additional storage in the building, climate controlled. We all know what they charge for, self-storage facilities. So I think this will be another great feature. Next, I'd like to go over to some of the exterior renderings. So the exterior is probably one of our largest tasks to take on at this project. We're challenged with the feat of taking what looks like a large government office building and make it into an attractive apartment, where people want to be proud to call it their home. Now these renderings are still rough, but it'll give you a quick glance at like kind of what some of the final ideas may look like. With the design ideas ranging from painting the building gray, maybe adding black windows. This will make it more modern and attractive for what tenants are looking for these days. We plan on making some suspended balconies off certain units. This will add some dimension to the building, but also create higher demand and prices for those units. These features, along with adding things like islands in the landscaping with the parking lot, making some exterior green spaces for common use, and just softening the overall tone, we should have a really attractive and welcoming apartment building. Next, really and final, would be the construction budget. So let's dive into the construction cost. With our gut renovation cost of approximately $109 per square foot, the total project capitalization is $1.7 million, with some good built-in line items for contingencies and some general conditions of over $1 million. This will be averaging the build cost per unit to around $148,000. Our exit strategy includes basically two key options: refinancing around year 2, or a full disposition around the 7-year mark. With the market comps suggesting an exit value exceeding $190,000 per unit, this project should offer a strong investment potential with a minimalized risk for our investors.
All right, Clint, I'm going to jump in here. One other thing to point out with the construction budget is we factored approximately 10% contingency for any possible change orders and construction mishaps. I would also like to point out, though, that this is change orders have been mitigated since we have done a lot of exploratory demolition to determine where exactly a lot of the different infrastructure within the building resides. So, whereas, doing demo without knowing what's underneath, now we do. So we're able to mitigate a lot of those costly change orders. So I'm going to go through kind of the overview from the financial side of things. I'm going to touch on, generally our business plan, and then also talk a little bit about the project location and why we believe the Patuxent area is one that could provide, immense upside for this project and for our investors. So first and foremost, 79 units total. We've discussed that. The build style is 4 stories. There's actually an elevator in here. We don't have to allot any additional construction budget for, elevator upgrades that's already existing, or another elevator. Total construction costs are $11.7 million. That's roughly $148,000 per unit. Our business plan is pretty simple. We're going to build at 148, which is, a pretty fair construction budget on a per unit basis. And then we're going to wait for the market to tell us when to sell. So conservatively, right now, there are sales comps in this market and around Harrisburg that are trading between 170 and 200,000. In year 7, we're projecting to sell this at $194,000 per unit. Right now, when we deliver this project, we're projecting average rents to be about $1,424 per unit. And then a couple of other interesting metrics. Everything, if you're a multifamily investor, a lot of things revolve around the cap rate. Our cap rate on disposition is 6.5%. That's pretty conservative. The market for Harrisburg, because of how competitive the market is about 6%. And then the second thing, when you do a development project, you're always looking at costs relative to how much operating income or NOI you're going to generate. Because of where interest rates are right now, how costly it is to do projects, anything above 7% is good. This project, we have it projected at 7.7%. So there's a big delta between what's market and what's going to take to actually construct this thing. From a high level overview, we're projecting 12 to 15 months construction, beginning as early as this month. We're targeting a refinance in month 24, which is going to yield a 65% return of initial capital. And let me talk about the exit on the next slide. So I went through the capitalization of the project, about $12 million. The average build cost of $148,000. Now let's talk about the disposition. Everybody wants to know, when do they get their money back, and how much are they going to earn? So this project has 2 capital events basically. One is a refinance in year 2. What we're trying to do is provide or return investor capital in a safe manner and as quickly as possible once we have the building stabilized. So whereas in 2019, before the pandemic and before things got crazy with interest rates and banks, we would have expected on a project like this to return 100% of capital after the project was built and stabilized. That's just not what we see in the market today. So this project, I think has a great return in year two. Once we refinance, we're targeting 65% of initial capital. Now the exit strategy, it's kind of like a push and pull, right? We can't project where the market's going to be. We're not smart enough to project where things are going to shape up on the commercial real estate side in 2 years, 3 years, 4 years, 5 years, 6 years. But really what we're targeting and what's going to drive our disposition is the multiple of invested capital, or your equity multiple. So under a 7-year projection, and the reason that we did 7 years is because we believe that we can get out of the cycle that we're in right now, and that we're going to be in another cycle poised for growth. So across 7 years, we're going to be in a much better, we can positively say with a little bit of confidence that we're going to be in a much better place. So based on our projections, after 7 years, we're planning to return 2.5x initial capital to everybody, and that will be through a sale. Now, there's also, some other things could happen, right? I mean, we could see a turn in the commercial real estate market happen much quicker. So a lot of our decision making is going to be driven by, what's the fair market value and how much capital, we can generate for our investors. So Harrisburg, a lot of people don't realize how fun of a market this can be if you're in the right places. Dauphin County, I think where we are in particular, is a really exciting area. We have 2 target markets here. We think we're going to be able to rent to 2 basically age cohorts, the 25 to 35-year-olds, and then also folks that are older than 55 years old. The 55 and older market, or the empty nesters, is interesting because, believe it or not, Harrisburg is one of the top markets to retire. That beats Tampa, that beats Sarasota, that beats Philadelphia. And they go by basically a myriad of different factors, including tax rate, livability, walkability, and so forth. And we're not just talking about a random news publication. This is like the U.S. News Report. The other really surprising thing is how competitive Harrisburg is. Harrisburg has ranked in 2022, 2023, and 2024 top 5 of 137 markets, small markets, mind you, of over 50,000 or less than 1 million inhabitants, but nonetheless, one of the most competitive markets. Out of every 16 renters, there's only 1 open vacancy across the entire market. So we think that we have the demand figured out here. Now, the next thing, speaking of demand, is really what employers are here, what's driving this, or what's driving our confidence that we're going to be able to fill this at 100% occupancy and we're going to be able to get the rents that we want. Well, there's a lot of diversity in employers and employment in this area. The foundation of Harrisburg is actually set by the government. There are actually over 40,000 government workers in that area, from between the Commonwealth of PA and the U.S. government. And then you have Hershey Foods, which provides another 10,000 plus jobs to the market. You have Highmark Blue Shield, which is another 5,500 jobs in the market. What I like about this, we are in a borough that is very insulated, and believe it or not, has a very high percentage of white collar. White collar are those professionals that occupy management or administration type positions that are generally, I want to say overly affluent, but provide a really good stable base of income. Compared to the rest of the United States, if you take the Harrisburg market, which is 80.1%, the rest of the United States average is about 51%. So we're well above that. Then people are like, what brings us to Harrisburg? What are the exciting things that are happening around here? So we are just over the I-83 South Bridge. Coincidentally, in July of this year, the US government and the state of PA announced a $500 million grant to improve that bridge. That's basically going to drive what we believe to be a lot more economics into this region. Currently, there's 125,000 cars that pass over that bridge every day, but as that bridge is expanded, transportation and commerce are going to grow in that area. Now, the next most exciting thing is the Soterra Exchange. So the Harrisburg Mall is being redeveloped by St. John's Properties. They are developing over 550,000 square feet of mixed use, office, shopping, retail, you name it. That's what's going in the new Harrisburg Mall area. They're changing the name, but if you just do some simple math at $150 per square foot build costs, at 550,000 square feet, you're looking at a project that's almost $1 billion. Immediate job impact is 1,000 jobs, and that is directly south of us within basically a quarter of a mile. So that's super exciting for us. Now, the last thing is to point out, just 2.3 miles away, another developer delivered a project in Steelton, which we never thought was going to be fully occupied, and within 3 months that was fully occupied. So that just sort of gives us more and more confidence that we are nestled in the right area. All right, next, finally, is our rent comps, and I just wanted to touch on a few of these. So the rent comps that we're presenting right here are comps from March 2024. So, roughly 6 or 7 months old. We went through and prior to this presentation, we updated our own internal rent comps. And I will point out that rent comps over the course of 7 months on multifamily apartments, not single family rentals or 1 and 2 small multifamily properties, but true apartment complexes for a studio and a 1-bed bath apartment are up about 7.3%. So here we had basically 1.76 price per square foot. We believe that's up to 1.85. The studios are up commensurately, and then the 2-bed and 1-bath are up to $1.6 per square foot. In terms of where our rent comps and what we believe to be the most accurate rent comp, it's very tough. I mean, you have Steelworks, which is a brand new complex. So in terms of occupancy and finishes, we think Steelworks is pretty comparable, but then in terms of price and amenities between the clubhouse and fitness center and that sort of thing, we believe that Ivy Ridge is a comparable, but then at the flip side, Ivy Ridge only offers 2 bedrooms. So we have a good mix, I think, of studios, 1 bedrooms and 2 bedrooms to sort of take advantage of these different market dynamics.
So let me jump in here we're almost just the last couple of few slides before we go to Q&A. So we wanted to explain the structure. As was mentioned earlier, the minimum investment suggested is $150,000. By the way, one cool thing about that, which is just a way to make it very real, is that this is a 79 unit building with a $2.6 million $2.6 million is the total equity raise. And so for every $150,000 that someone puts in, it roughly equates to owning 4.5 units. So if you think about the leverage on that money, by investing $150,000, you actually end up sort of synthetically owning 4.5 units, which is a lot more than probably that money would go if you were to try to do it through single family. So as we mentioned, the average annual return that would be generated from the structure that we're showing you here is 20.9%, which is an attractive return. That's assuming the 7-year hold. The equity multiplier that Josh already mentioned is 2.5 times. So you would make 2.5 times your money on the, say, 150 or 200 or whatever your investment amount is, assuming we hit the projections that we have modeled in and assumed here. The way that the structure is designed so that investors get all of their money back plus a preferred return before we as the sponsors get to participate in the upside. So clearly we're incentivized as a group to generate these returns and hopefully do a great job. So the 20.9% average annual return is assuming that investors will first get their money back plus the 8% preferred return. And then the structure is a 60-40 split. So basically, investors will then own 60% of all profits going forward. And the sponsors will own 40% of all profits once investors have received 100% of their cash flow, cash back, plus the 8% return on their money. And another really important point is as Eric had pointed out, we're all experienced, we're all successful folks. But one thing I look for is, what's the skin in the game? And we just wanted to share that in this structure, we have substantial skin in the game. So out of that 2.6 million, we're going to have more than 400K invested. Plus the partners are going to guarantee the construction loan, which is about $9 million. And as those who may be experienced, when you go to a bank for a loan, they're also looking for outside liquidity of around 15% of project costs. So this is just a way to say that we have substantial skin in the game as a partnership, and we are committed to making this successful for our investors and for ourselves.
All right, so we're going to get into really quickly to breeze past this. The timeline of construction, just to reiterate, is 12 to 15 months, and we're aiming for delivery in March 2026. How are we going to ensure success when it comes to a refinance in month 24? Well, that comes to our property management partner, who we've been working with over the last 4 months to hone in on our construction documents, our unit offering, and to really get a better read on this market and where we're going to be at competitively. So importantly, our property management company is Boyd Wilson. They have over 3,400 units, in the central PA market. They have experience in Dauphin County. They're managing a brand new project in Hershey, which we think is very comparable to ours. And then we also have direct experience with them, having one of our partners has a project where they're managing some new build of theirs in Dover. So we've had nothing but great things to say about Boyd Wilson, the property management company. One interesting note here, or just one note is just about a month ago, Boyd Wilson said that we should move up our 1-bedroom rents. So we didn't show that, or we're not projecting that increase just yet in our numbers or underwriting. We think that that's just sort of a cherry on top. But they were basically saying that we could probably get more than $75 per unit per month over and above what we originally underwritten. In the past, and we have experience with this, Boyd Wilson is very adept at pre-leasing. So, going into March 2026, or really that, those winter months, we would expect to be pre-leased in the neighborhood of 25 to 30%, which is going to allow us to get to stabilization much quicker. And then the last thing, Ken just touched on this, but here's a representation of what a $250,000 investment looks like in terms of investment. Year 2, to point out, we're taking and refinancing this property. That's where this 65% of initial capital is returned. Years 3 through 6, we're basically still paying down the preferred return and your initial capital, to a point where, you have all your initial capital back by, year 6. And then when we go and dispose of the property, that's when the boost of excess cash flow and return hits. So all in all, we're projecting this conservatively to be 7 years. So we have you, at least patient, as the market turns. But there's an opportunity or possibility that things turn out better, well ahead of schedule, and we might be seeing these type of equity multiple returns sooner. But the way that we projected and the way that we were thinking about this is we wanted to ensure that people were sort of in this for the long term with us.
Eric, you're muted.
Thank you. So our hopes are that we've covered the bulk of the information that you were searching for when you attended today. However, we realize that there could be one of potential three outcomes. One, you may need more information. So we have the ability for you to connect with us one-on-one to ask more detailed questions about your individual investment and get some additional information that we may have covered here today. This may not be the right investment for you, and that's okay too. Our goal was to take all of the people that have reached out with interest and provide you enough information that you could either opt out, opt in, or potentially seek more information if you were looking to proceed, but had a few questions that weren't quite answered potentially during today's webinar. So step one would be to schedule an onboarding call if you're ready to move forward. Step two we would email you and review with you the investor docs, and then we would schedule an actual time for you to make the deposit. So if you would like to schedule an onboarding call or to simply schedule a one-on-one with a member of our investor success team, we'll get you the information here to go ahead and schedule that. We'll make it really easy with a Calendly link or a simple email or text message that we can do that. And then we've allocated about 15 or so minutes here at the end of the webinar for some open Q&A. Who has questions?
Let me lob one out there. This one's for Ken. Ken, what are the tax benefits of investing in this this project? Maybe not, day one, but in the future.
Yeah, sure. So one of the things that attracts me, for those that don't know, as Eric sort of touched on in my bio, so I run an investment firm and we manage over $300 million for multiple investors. And so I've been focusing on real estate now for a good while, but I'd say 7-8 years especially. So when interest rates were very low, I thought real estate was a great place to generate income, but not just cash flow and income, but also very tax efficiently. So the benefits of a project like this is a couple of things. One of the main ones is that depreciation, which is sort of an expense, but it's not really economically true, is something that really benefits from a tax perspective. So what we would do on a project like this, like Capital Flats, is do what's called a cost segregation study. And so what that would allow us to do is take the budget of 11 some million and allow us to take, so if we didn't do a study like that, we would depreciate that 11 odd million value over a long period of time. But by doing this study, we can take a bunch of those assets that are in that $11 million budget and move them into much faster depreciating categories. And currently, there is essentially accelerated depreciation for a bunch of those categories. So what that would allow us to do is by doing a study, we could accelerate the depreciation, which gives a substantial tax write-off. And then there's an ongoing tax write-off that remains year after year until we sell the property. So all of those write-offs essentially would flow through to investors in whatever proportion they are invested. And obviously we're in an election year, as I mentioned, so depending on the outcome of the election, that could actually impact maybe the possibility of some of those accelerated depreciation write-offs being renewed or even increased to incentivize investment. And if that happens, that would be even more beneficial.
Does anybody want to answer this question? What is my liability as a limited partner investor?
I can take that one as well, since I have the legal background. So the great thing about being a limited partner, as opposed to a general partner, is that the structure of the partnership is that the limited partners are not responsible for anything past their investment. Whereas as general partners, as we touched on already, in the skin in the game concept, for example, various partners will sign on to guarantee the debt or to guarantee other aspects, but limited partners, they don't have to do any of those guarantees. They just get the benefits without having to guarantee anything. So the liability is limited to the investment that you make, and you are not liable for anything more than that.
I got one that came through the Q&A. Clint, this is probably best for you. Somebody just asked what the team's experience and background in construction is, and then also what is the next step? What happens after this today to get further interest in the opportunity? If you want to handle both those or the first part at least.
Yeah, I'll take the first one real quick about the construction. My background in construction spans over 25 years. I've pretty much have worked in about every avenue from flipped houses long time ago, became a builder, developer. I've done a lot of neighborhoods, a lot of commercial projects. Currently doing a lot of commercial development, multifamily. I owned one of the larger construction companies that did value adds up and down the East Coast about 10 years ago. So project like this is pretty straightforward. I want to say fairly simple project for us. It's exciting, but it's nothing outside of our realm that we can't handle. Like I said, I've been pretty much around it doing it for about 25 plus years now. So I think my diverse background, it helps me on everything, especially in a project like this, because some of it is development with like stormwater management requirements that are in place to be able to evaluate those, existing building structures, understanding how they were built, as we talked about earlier in this presentation today. So really just having a well-rounded background really makes it easy. I love materials, so that really helps out, I think, when we were talking about this design elements for the exterior. I love being up to date with new materials, like why they're using them, energy efficient materials, and it just makes a better product overall. And then if somebody want to jump in on the next steps, or I can.
Yeah, I think it was just formalization of how to get started, which is probably distribution of the documents. So whomever could explain that process best.
Yeah, let me take that as well. So this type of presentation, or what we call the offering memorandum, is really the descriptive part. But effectively, when you become an investor, there's just basically some legal documents that are a little more legalistic. So you just get the document, which is called a private placement memorandum, and that has also another document called a subscription agreement. So the process is pretty simple. You review the private placement memorandum, you sign the subscription agreement, and then once we confirm receipt of the subscription agreement, you wire the funds and we confirm receipt of the funds. That's pretty much the whole process. After that's done, we'll obviously be giving folks updates, sort of keeping them regularly updated on our progress. But the front end is simply to review those documents, sign the documents, and then wire the funds or send a check.
And then Ken, just to add to that, I would say that this offering has like the utmost regulatory compliance to it. We are registered with the SEC, a 506C offering. So this indication is registered with the SEC.
We have a slide up here as well. If you would like to connect with us about those next steps, there's two different ways to do that. There's a QR code up there. You can scan that real quick, and that'll take you to a super easy way to schedule a one-on-one call with Grant. We also have contact information up there for Josh. There's an email and also a cell phone number and office number. There's two different ways for you to connect with us, ask questions, schedule your onboarding and investor doc signing. Either of those contacts would be fine for you to schedule next steps. I saw a private message here in the Q&A. Question about the property management company. I'd answered it in the chat, but also why Boyd Wilson? And then how do we see them playing an integral part in the success of this project. Josh, are you familiar with Boyd Wilson? You want to talk a little bit about how we selected them and what makes them qualified as the property management company to lead that charge?
Yeah, I mean, the selection process was, our comfort level with them. We've seen, firsthand how well they performed. I think they're very skilled at marketing. Basically all lease up is marketing. They're very sophisticated on that front. They're attuned with this market, and they're sort of like a Goldilocks. They're not too big and not too small. Certainly sophisticated in managing 3,400 units, but certainly not, 20,000 where we get lost in the shuffle. Having access to their management team is very helpful as we, continue to refine assumptions and then make the right selections on the construction side.
Cool. I'd say that we've covered everything we intended. Wanted to finish up at the top of the hour. So if there's any other questions, the time would be now. Otherwise, we'll plan to wrap up here. Again, next steps, 2 different ways to schedule to connect with our team, to answer any additional questions you might have, or to basically schedule an onboarding call to join us in this project. There we go. Vic says, when do you expect the units to be fully occupied? We can probably work a little bit backwards from stabilization. Clint or Josh, you want to address that? Stabilization and refinance at month 24 would obviously predict that, I don't know about fully occupied, but darn close to it, or maybe 100% would obviously happen before stabilization. You want to elaborate a little bit on that?
Yeah, I'll touch on that one, and Clint, you can jump in here. So if we take the full 15 months of, and honestly, like we're anywhere between 12 and 15, but we want to give ourselves 15 months for construction here. That puts us in March 2026, 30% occupied. We will hit the spring lease up season. I think that's critical. And then from there, if we're at 25 or 30%, we're aiming to have 10 to 15 new leases per month. So we'll be pushing for a refinance, likely by July of 2026. Generally, any kind of refinance process takes 2 to 3 to 4 months, so that takes you all the way up to the 24 months.
We clear out the Q&A. Any other chat? Looks like we've answered all the questions. I would say that's a wrap. I appreciate everybody joining us. We will look for your scheduling of an onboarding call if you have interest, or any additional questions. Again, before we sign off, we'll put up, you can see there's the QR code to schedule a one-on-one. Also, you can connect with Josh via email or phone. We've also posted directly in the chat the link to a Calendly, and as well as email addresses to get more information or to schedule your onboarding call. Appreciate everybody's time, and we'll see you later.